Life insurance basis. Many financial experts consider life insurance to be the cornerstone of sound financial planning. It can be an important tool in the following situations: replace income for dependents. If people depend on an individual income, life insurance can replace that income if the person dies. The most common example of this is parents with young children. Insurance to replace income can be especially useful in the government or employer sponsored benefits of the surviving spouse or domestic partner will be reduced after he or she dies. Pay final expenses. Life insurance can pay funeral and burial cost, proteb- probate and other estate administration cost, debits and medical expenses not covered by health insurance. Create an inheritance for heirs. Even those with no other assist to pass on can create an insurance by buying a life insurance policy and naming their heirs as beneficiaries. Pay federal death taxes and state death taxes. Life insurance benefits can pay for estimate taxes so that heirs will not have to liquidate or other assist or take a smaller inheritance. Change in the federal death tax rules through January 1 to 2012 will likely lessen the impact of this tax on some people, but some states also offering those federal decrees with increase in their state level estate taxes make significant charitable contribution by making a charity the beneficiary of their life insurance policies. Individuals can make a much large contribution than if they donate the cash equivalent of the policy premiums, create a source of savings. Some Some types of create a source of savings. Some types of life insurance create a cash value that, if not paid out as a death benefit, can be borrowed or withdrawn on the owner request. Since most people make paying their life insurance policy premiums as a high priority, buying a cash value type policy can create a kind of force saving plans. Furthermore, the interest created is tax deferred and tax expand if the money is paid as a death claim. Types of life insurance. There are two major types of life insurance: term and whole life. Term life. Term insurance is the simplest form of life insurance. It pays only It pays only if death occurs during the terms of policy, which is usually for from 1 to 30 years. Most term policies have no other benefit provisions. There are two basic types of term life insurance policy: level term and decreasing term. Level term means that the death benefit stays the same out throughout the duration of the policy. Decreasing term means that the death benefit drops, usually in 1 year's increasing meant over the course of the policy terms. Whole life, permanent life. Whole life or permanent insurance pays a death benefit whenever the policyholder dies. There are three major types of whole life or permanent insurance: traditional whole life, universal life, and variable and valuable universal life, and there are variation within each type. In case of traditional whole life, both the death benefit and the premium are designed to stay the same throughout the life of the policy. The cost per $1,000 of benefit increased. This as the insured person age, and it obviously gets very high when the insured lives to 80 and beyond. The insurance company keeps the premium level by charging a premium that in the early years is higher than what is needed to pay claims, invested that money, and then using it is to supplement the level premium to pay help the cost of the insurance for older people. By law, when these overpayments reach a certain amount, they must be available to the policyholders as a cash value if he or she dies, not to continue with the original plan. The cash value is an alternate, not an additional benefit under the policy. In the 1970s and 1980s, life insurance companies introduced variations on the traditional whole life product, universal life insurance, and variable universal life insurance. Universal life. Universal life, also known as adjustable life, allows more flexibility than traditional whole life policies. The saving vehicles, called a cash value account, generally earns a money market rate of interest after money has accumulated. Then, in the account, the policyholder will also have the option of altering premium payment providing there is enough money in the account to cover their costs.